there were some specific questions that were asked of me to comment on this week, so let me see if I can get these. Terry asked, when entering a swing trade using the auto framer, sometimes the entry is hit on the first bar, morning gap, and then down she goes. Does the 10 a.m. rule apply? I would say generally yes. You know, if you don't want to become like an intraday trader and trying to optimize those entries, even if you just waited an hour, I think you'd be fine. Let the first hour bar close and then play an hourly breakout. If the price is still above the green line, go ahead and take it. Or if it's an hourly breakout, go ahead and take it. If you're going to be around in the morning, I think you can use some of that morning hook technique to get a better entry. But otherwise, one of the things you have to compute is the maximum price that you can afford to pay and still have 2 to 1. So here's what I mean by that. Now, typically, we're going to have a trade frame that looks like this, where the day before we had a market day that looked like this. And so when we trade frame that one, we're going to buy 5 cents above the high and a stop 5 cents below the low. And then we got this 10-day high over here, and that's our target. So we've got, this is our range risk of an R, and we'll call that, let's call it in this case 3R. So if we get, what you're talking about is if there's a gap up at the opening, should I buy it immediately? Well, one of the things you can do and should do is figure out how high I can buy it and still have, and my risk would still be down here, and I can still have a 2 to 1 reward to risk ratio on a test of the 10-day high. So what you'll see that gives you is there's like an entry box that says if it opens inside yesterday's range and starts moving up, so here's yesterday's range. If it opens inside yesterday's range and goes up, I can buy it 5 cents above. I can buy it right here. Or if it gaps above this, if it's up in this box, if it's inside the box, I can still buy it with my stop down here. But if it gaps up higher than that level, then I no longer have 2 to 1. And then I don't take the trade unless it comes back down, finds support, and then goes back above yesterday's high. Then I would buy that one right here. All right, Terry, does that make sense to you? I think Terry was on. Okay, good. Patrick asked on ETF2, what's the difference between the theoretical exposure and the model portfolio? So, briefly, what you'll notice on the report page is that there is there's an asset allocation number on the left-hand side where it will talk about percent invested and then the percent in cash. And where it stands right now is 0 and 100. Okay, and the reason is that all 10 of the regional indexes are on cash positions. Let me just, rather than draw it, let me just bring it over and show you. How about that? Okay, so this is the screen for the ETF2, and this is really more of an asset allocation adjusted weekly than it is swing trades per se. So it's more like a longer-term system with weekly adjustments. So that's why I haven't. I'm going to talk about it when we get into the strategy week. But since you asked, so on this regional summary, these are the 10 big ETFs in the world market model. And I check each one of them against their own moving average for a filter of either buy it or it's in cash. Well, right now, all of them are below their 4-month moving average, so they get signaled to cash. So in the asset allocation strategy, each one of those controls about 10% of the allocation. So when all 10 are on cash, then the theoretical allocation should be 0% invested and 100% cash. Now, if I had no positions and I had all my portfolio in cash, what that means is I cannot add any new positions. And so this tends to fluctuate fairly rapidly. Right now it's been cash for a while, but let's say that right now I had no positions. And then next week, 2 of them went to a buy position. This would shift to 20% invested, 80% cash in the theoretical model because the market is slowly starting to heal. What that tells me is that in ETF2, I can buy 2 new positions from the list of relative strength winners, and then, but no more than that. The most I can buy any week is like 4, so that we don't go whole hog. But if 2 of them went to cash or went to invested instead of cash, we'd be 20/80. Then I could buy 2 positions. So the asset allocation model is a governor of how much money I can add into the market based on the health of all the regions. Is that making sense so far? Okay. But then what I have is in previous weeks, the market was healthy enough for me to buy positions, and so I bought from among the relative strength leaders according to the guidance that's in the ETF2 principles. And each one of those has a 10% trailing stop from the highest high while in the trade. Once I have that position on, the only way I get out of that position is if that stop is hit, or if it goes below the database average and is now no longer a relative strength leader, then I'll go ahead and get out of it. But I will not use the broad market health check as a way to justify getting out of a relative strength leader. I let the each trade's managed stop guide that. So let's say I had 10 positions on, and the market went from 100% invested to 50% invested, 50% cash. And let's say that 6 of the positions were hit. So now I only have 40% invested, and I have 60% cash in the actual portfolio. And then the investment cash ratio is 50-50. That would allow me to add 1 new position to get me back up to my not to exceed asset allocation. I can buy up to that level, but I can't go past it. So in effect, what this does is prevents us in a really sharply falling market to put money back into it once it gets cycled out. So if some of those relative strength leaders got hit and then I generated cash, there could still be some relative strength leaders that are still on a buy position because they have so far to fall that they're not back below their 4-month moving average. But the asset allocation would prevent me from throwing that money back into the fire until the whole market itself began to stabilize a little bit. So this is what creates a very conservative risk exposure to money. The market has to be healthy enough to put the new money in, and then once the money is in, the dynamics of each position determine whether or not it gets out, but not the overall asset allocation. Yes, correct. Robert says, it stops us from reinvesting the cash while the model is in this current status. That's absolutely correct. And it's performing just like it is supposed to right now. We started the year at 10 positions. We're down to 7. 30% of the model portfolio is in cash. All of the 7 positions are doing are not even near their 10% trailing stop, and that model is about 4% ahead of the S&P right now. So it's conservative, and it's the this regulator, this governor is keeping us from throwing money into the market too soon. Make sense? I still owe you the rule set on that too. I'll get that hung. SQN versus the previous methodology. Yes, I'm using the SQN as a way to define the risk-adjusted performance value of these. It's a very nice way to. Oh, those are Robert. Sorry. Yeah. So Robert, you asked me about the SQN versus the previous methodology in ETF2. I am very much in favor of it. It is the slowest of the three members of ETF2 to change. So you get the strength changes pretty quickly. The consistency is a 10-week moving average. And then the 40-week system quality number is the slowest of the three measurements in the ETF2 to change. And so it's performing as designed. I will send you the stats on ETF2, the expectancy and wins and all that later. I've got, the record of all the live forward trades of it, and I can provide those in a separate email. Okay, so that was all the FAQs. So what I want to say about that now is, as you go through the homework and the messages with each other and the videos, if there are things that you can't resolve or you just need to hear me talk about, please use that consolidated FAQ right board to put topics on there so that I can make sure that I address the things that you need me to talk about, so that if you just have it buried in the message boards, I may not see it. So get it up on this chalkboard like you did here so that I can talk about these going forward. As we start getting deeper and deeper into the technical parts of the systems, that will become more important. Okay. Okay, so the next thing I want to cover is, I would just say, the chat room and mastermind insights. And I'm going to give a thumbnail description of these because there's about 20 of them. And so what I'd like you to do is just kind of take notes on these as I'm talking about them. And then if there's something that you really want me to cover more about, I can add that into some videos this week, and I'll get them posted. And so these were originally some things that I started talking to the Super Trader program about because I was concerned that they were not paying enough attention to the ongoing lessons learned that come from the practice of trading, that they're doing a lot of theoretical work and psychological work in preparation, and then they get their systems and then off they go. And I was concerned that I think it's important that you continue to learn as you go in a systematic way, like using action research and action learning, like in the reflective learning journal. And that's so important that I wanted to share with them the things that I'm learning and that our chat room has learned over the last 5 to 10 years of doing this. Maybe this is the next ebook or the next 100 essays. So the first thing is that there is indisputably a chat room mastermind effect, and that is you're already seeing it in the discussion boards in this classroom and then also in the daily practice of the chat room, that there is a tremendous amount of crosstalk and mutual learning and mutual support that's going on. Enough on that. Feeding the bulldog every day, and this is from my own practice, and that is I want to get paid every day. That when I'm looking at open profits and I'm looking at performance numbers and all that stuff, for me psychologically it's a good thing to get paid every day early, so that I can put some money in the bank. I can take care of business and practically ring the bell. Where do beliefs come from? Maybe this is one you might want to hear more on later, but when I did the washout video, I explained where I came up with a set of beliefs that ended up becoming the foundation for the washout pattern. It started with a list of conventional beliefs from readings and from the media, and then I took the exact opposite of each belief and then turned that operationally into a system. So when you are describing the beliefs that you have that support your processes and support your actions, I really think it's important to trace that back to the original source and then consider the evidence for it. And then what would it take to convince you that belief was wrong? And then ask the question, what's the value add of having that belief? Because I have that belief, what can I now go forward and do? Or is that belief even necessary at all? Is that a belief that I have to have? Do I have to take a position on that idea, or can I just let it go and just concentrate on other things that matter? So the discussion of where do beliefs come from is foundational to the psychological work in your learning journal. Connectivism and the market mosaic. Connectivism is this idea that the world is so large that it can't fit inside your head. And so what we end up doing is linking together cognitive resources to paint a larger picture that's three-dimensional or four-dimensional, adding time. And so the market mosaic is like that for us. There's a lot of indicators that are in there that are not tied directly to actionable systems, but which taken collectively help me start feeling my way through this fog of the market state. And so connectivism is the way in educational theory we talk about the phenomenon of linking together networks of actors and processes to gain a rich description of the world. So the market mosaic is all those extra things in the daily and weekly report that give some insights into this complex market mosaic. The next one is the trader quality number, and this is a discussion really for the difference between systems and strategies. So a system is something that you can trade robotically, like the frog intraday, or any of these 6 systems that I've provided you. If you were to trade them mechanically, robotically, you would come up with a particular system quality number. If you decided to apply your discretion to change a rule or to modify a rule, then you're going to get a different result. So what you should do is, every time you do that, document the change that you made and the justification for it, so you can study the connection to the belief. And then when you have enough of those data points, you can now determine statistically if that decision adds value or reduces value over the long term and over large data sets. And then you can compare the difference between your performance with discretion and without discretion. And then whatever that number is your trader quality number. And for each of your systems and in your time frames, you should know whether or not your judgment is adding value to the robotic system or not. And if it is, then you should continue to use it and continue to calibrate it until such time as it no longer adds value. And from that, you can start finding cause and effect things in your decision making, which can be systematized and added as rules to your system, and thus reduce the workload and the pressure on your intuition to keep going. So that's sort of the action research inductive process of learning in a nutshell. And the idea is the trader quality number that gives you insight into whether or not you should keep doing what you're doing. Next, this leads into your system is what you do. It's not what you write. And this is important for discretionary traders. You can have heuristics and rules of thumb, but remember that what you actually do is what your system is, and that the written words on a page are only the guide unless you follow them religiously. So your system is what you do, not what you say. Double loop learning, learning styles, auditory learning. So double loop learning has to do with the metacognition or reflection about how you learn and whether or not that is effective. So a single loop learning is where you study something, you come to a conclusion, and then you make a change. Double loop learning means that you consider why you thought that was a lesson that should be learned, what process you used to evaluate the data, and you're looking at your process for learning and not just the content of the things that come out of that particular trade. And then when you couple that with learning styles, and for me, and being an auditory learner, there are ways in which you can improve your sustainable rate of learning if you pay attention to how you process information and where you are most effective in terms of visual, auditory, and kinesthetic. Brain mode power can help on that one. And it has a lot to do with getting your mind state right and having a routine process for doing the daily, weekly, monthly after action reviews that get you into the learning mode. The quote, "that coal won't shovel itself," that's a note to myself that a lot of times I just get satisfied with having the insight. And I know right now I'm almost 60, and a couple months ago I had an idea in the hot tub and I didn't write it down, and for the life of me I can't remember what it was, but I know it was an extension of the RLFF framework, I believe. And I'm just kicking myself for not having written it down and then systematically developed it, because as much fun as it was to come up with the idea, if I can't put it into practice, if I don't deliver on it, then the insight is of little value. And so in the 4-part learning journal, you have 4 columns. You have the aha moment, which is the rich description of what happened. You have the column for reflective learning, and that's where the insight is developed. The 3rd column is the important one, the commitment to action, what you're going to do about it. And then the 4th column is the results. And in this last example, because I didn't get it into the journal in time, that thing has escaped my brain. Now they got to wait for it to come around on the merry-go-round again. Hopefully, maybe it was something about the hybrid frog. I'm hoping that's what it is, because that's a pretty good idea. So that's what I mean by the coal won't shovel itself. It's not enough just to have the idea and the flash of insight. You've got to deliver that. You got to deliver that product on time, on spec to a paying customer. And that's what I mean. We still have to do the work. You got to shovel that coal and get it done. Telling the universe. When you put things in writing, when you document them, when you make a declaration that you're going to do something, it makes a difference. You've put the universe on notice that you are committed to doing that, and that that's your intention. That intention helps you achieve that. So putting things in writing, working with your accountability partner, putting a mark on the wall, that's part of that part 3 of the learning journal. Get it in writing and then make it happen, make it manifest. Remember that all your preparation is for the moment of execution so that you can trade that in a relaxed manner and execute. That the preparation sometimes feels like the fun. For me, it's the fun part. But if that does not lead to improved performance or actual performance, then the preparation, I have to question why am I even doing that? On days where the market gaps up and then sells off the entire rest of the day for a range stat move, I have to look at myself and say, now, on this perfect intraday trending downward day that moved a range stat, was I on the correct side of the market? Was I getting, if I started long, did I correct myself and get short and stay that way and keep exploiting the primary move of the day? If I don't, then all of the preparation and rehearsal that I do is not worth it, because it's getting in the way of me identifying the simplest and easiest move of all. So just remember that all your preparation is so that when it comes time to execute, you can do that with confidence in a relaxed, alert state. Phase transitions in critical states has to do with, well, it's really connected to a comment Robert made in the one of the message boards, and that is that all indicators are wrong at the end of a move. And so we know that, and one of the things we have to do then is fine-tune our indicators so that they don't stay wrong too long. You don't have to be right all the time, but you cannot afford to stay wrong too long. And so if you think about the combination of the 10-period regression line and the dragon, that's a way to fine-tune the turning point in the market. The RLCO moment when the 10 crosses the 30 is one of those. But the dragon and the 10 period regression line form another way that I'm really becoming fond of. It's a noise adaptive band that keeps you on the correct side of the market, but also helps you make those phase transitions. And because the best trades are the ones that come out of critical states, we want to be able to recognize them when they happen. So that's dojis that appear near support and resistance. Price that has started to slow down and is beginning to hesitate vicinity high of the day or low of the day. That's a critical state. We want to be ready for the sharp moves out of there. We don't want to be surprised when that happens because that's what it's supposed to do. Phase transitions have to do with times when the market is rolling over. It's gone through one steady phase, and now it's in this transition process and starting to roll over. We've got to recognize that it's going to do what it's going to do and that we have to trade frame in both directions. The Xeno stop is the 2R battle drill, covers that in great detail. And again, that's one I think you ought to listen to every day for 30 days. Trade framing is the structured approach to providing cognitive scaffolding in a standard way each and every day across all of these different swing trades so that you have a standardized, systematic, holistic, consistent, disciplined way of evaluating risk and reward ratios and structuring your decision-making in a standard way. No matter how you feel, you can make this an objective piece of scaffolding. So when a mason is building his brick wall or is constructing the house, that house design may be different each time, but the way he sets up his scaffolding to support him on the building of that wall is always the same. So it's a standard way to economically and efficiently go through your value add process of trade framing. Snapping turtle and hybrid frog are my two favorite most intraday stuff. The snapping turtle is the idea that the first move out of a critical state is the easiest move. It's the biggest, strongest directional move in the same way that a snapping turtle with an 8-inch neck can move his head from inside that protected shell where you can't get at him, and he goes from 0 to 8 inches extension as fast as anything on the planet, accomplishes his purpose, and then gets back into safety right away. And so the snapping turtle is a way that I think about how to go from the initial entry position with a measured risk in a critical state to no lose plus dinner for two, and I can remove the risk to my seed capital. Once I do that, I feel like my emotional state, my psychology changes, and now it becomes a simpler science project about how much the market wants to give me and how much that I was able to take, but I haven't put my seed capital at any risk. And that's how I think of the snapping turtle. And then the hybrid frog is simply the most current way that I use to just get into the positions early, and allows me to do a balanced approach to between the leapfrog and the quick frog. It's an adjustment. It's like a second generation frog that I'm very happy with, and you've seen any number of examples of that over the last 6 months. 551W, if you listen to the executive summary of that system, you'll hear where ideas come from, and it's a perfect example of what happens when you pay close attention to your best practices and your modules and components, and you learn how to build robust systems that you can believe in from the components that you have already proved. Robert asked me about how does the snapping turtle relate to the swing trade that seems daily. It's really just day one technique, but it also has something to do with the moves out of critical states on swing trades. So if you look at our, the work we've done before on the bottoming tail or dojis at key support and resistance levels, the reversal moves out of those dojis look a lot like snapping turtles, in the sense that first move can quite often be the easiest move. And maybe on that first day, we get 80% of what we'd be happy to get over a 5-day period. And so if you're in a bear normal or bear volatile market like we are today, I think it pays you to come in near the end of the day to see, how did I do on day one? I got my entry and I'm holding 80% of the average trade that lasts 5 days. Why do I want to take any extra risk on that? Consider whether or not you want to bank some of that. That's what I mean by the snapping turtle performance. The next one, 0.25R improvement on every trade. If you are trading frequently and you have shorter time horizons and you're trying to cycle your inventory quite a bit, then if you can make a 1/4 of an hour improvement on every trade, you can reduce the losses by a little bit. You can keep a little bit more of the wins. You can make an enormous improvement in your overall performance rather than trying to get some Baroque adjustment to your trading rules that give you an additional 10R winner once a month. I would much rather try to just waste a little less on each trade by improving my technique and respecting the guy on the other side of the trade. Zero State we've talked about. Ready, Fire, Aim is an ebook that talks about trade. It's a strategy that allows us to trade in a way that we're prepared for moves. We can make low risk entries with partial positions and grow them as a function of reading price action as it progresses through the RLCO framework. So it's a way to do swing trading in a strategy way rather than a systemic way. And then the final note is that you are always trading, whether it's time for money or time for information or information for risk. Even when you elect not to trade, you're trading. Even if you turn over your trading to a mechanical system to run, you are trading your discretion for the regularity and discipline of that system. So no matter what you're doing, you are always, always, always trading. So those are maybe the top 20 insights that I shared with the super traders a while back that came out of our trading practice. And when I came back and revisited them, all of them still resonate strongly with me. And I think all of them connect to the larger challenges we have as swing traders. These fall into the area of beliefs and insights and maybe tips or techniques. So take them for what it's worth. You'll probably find essays on those kinds of things in the 150 trading essays that are in the ebooks. And I'll get with Catherine, make sure we have those uploaded for you. Okay, I'm going to take about a 2-minute break, and we're at this for about 15 minutes right now. I'm going to go take a 2-minute break and recharge my coffee. So if you need to take a break, the next thing that happens to finish up is I'm going to go through through some swing trade frames and show you how I'm thinking about the things that emerged for me from the weekend report. So let's take a 3-minute break, and then I'll be right back. Okay.